Hi guys, here's Hustle Hub. Today we're going to talk about mutual fund. A mutual fund is a financial instrument that gives investors the possibility to access a well-diversified and professionally managed portfolio. It can be invested in stocks, bonds, and the monetary market. They are always invested in liquid assets. After receiving capital from the investors, the managers allocate it based on the specific objectives of the fund. It can be focused on a particular sector like retail, tech, etc., or they can replicate specific indexes like the S&P 500. When you buy a mutual fund, you're a shareholder that takes the profits, the dividends, or the losses that may occur. By holding a share in a mutual fund, you're holding a diversified portfolio of stocks. The difference between single stocks and holding a mutual fund share is that the first give voting rights to the holders. It doesn't work this way in case of mutual funds. Mutual funds are usually managed by large investment companies like Vanguard, Fidelity, T. Rowe Price, etc. Every fund has its own fund manager and analysts looking for companies to add or remove from the portfolio. This doesn't happen if the mutual fund you're investing in is a passive one, for example, the funds that replicate indexes. Many times, the managers of the funds are heavily invested in the funds they manage. There are different types of mutual funds. The stock funds are heavily invested in the equities markets. They can be invested in companies in a specific sector or with a specific market cap range. There are also funds that invest in companies with particular multiples, like the value funds, that look for companies that follow value investing guidelines, and there are also funds that are focused on companies with high dividends. We have already talked about index funds. They replicate the performance of a specific index. They often have very low fees because it is a passive investment. It is reasonable to select these funds because active investments don't always outperform the market, but the fees are a lot higher. The fixed income funds are invested in bonds. They can be both government or corporate bonds. Lots of them are managed in an active manner because they try to profit off undervalued bonds, both because of the higher interest rate or the possible appreciation. The monetary market funds hold assets that expire in 1 year maximum, like the treasury bills. Balanced funds are diversified with different asset classes: equities, fixed income, and the monetary market. Of course, you can select funds that are invested in a particular region or country. Fees may vary on the type of mutual fund you pick. Passive funds are generally cheaper than active ones. Thank you guys for watching the video, and remember to give us all your support by subscribing to the channel, smashing the like button and turning on the notification bell. See you next time with another video for you. This is Hustle Hub.